excited to dive in, answer the questions that you have, share some of our insights, and set some next steps. With that, maybe let's go ahead and dive in. Andrew, you good to go? What do you think? Sarah, we good?
I think we're ready. I said we do it.
Let's do it.
Yeah. All right. So I'll introduce myself first. I'm Andrew Tudor, investment advisor here for Zenith Wealth Partners. Been an investment advisor for a little under a decade and really excited to share and give some actionable insights.
We go to the doctor. We gotta get
And I'm Jason Ray. I've led our investment team here at Zenith since inception. Excited to share a little bit about what we've learned and apply my also decade plus of experience in markets. Thanks, Andrew, and let's go ahead and dive in.
Okay, so for today, we're going to start with a recap of first quarter, see how markets performed, and talk through some of the economic data that we've seen. Also, the outlay of some of the drivers and key indicators of where we see things going in the future. We'll stop and do a post check. We really want to hear, how you're receiving markets, how your portfolio's doing, what your thoughts are, good, bad, or indifferent. Then we'll jump into our outlook for the next 6 to 12 months. And then we'll wrap with some key takeaways, with some great charts and some things for you to walk away with actionable steps, and then Q&A. So we really want engagement here. If you have questions, if we talk about a topic that doesn't make sense or you'd like more clarity on, talk back to us. We'd love to hear more.
Yeah. And in the latest edition of what you're reading is not what's actually happening. I think the first quarter represented a lot of that, right? We see a recap of the different asset classes, U.S. equities, international equities, U.S. bonds, and their returns in the first quarter. So through March 31. Some of those have changed so far, in the second quarter here in the first few weeks of April. We've seen U.S. markets really struggle compared to international peers. I feel like we've been talking about the opportunity with international equities here at Zenith for years, and it's coming true as valuations are more attractive, and there's potentially just more growth in emerging and international markets than there is here in the U.S. Obviously, tariffs and policy has all been in the news. I think those headlines have masked reality. We put out a rapid reaction that you can find on our website. Andrew says I look just like the cartoon, but I totally disagree. I don't
Pretty
think it
close
was at all.
Yeah, pretty close.
There was underlying fragility in the market. Valuations were high in equities. The US dollar had its strongest run in history. Interest rates are still in restrictive territory to restrict the economy. So those factors really just needed a match to set on fire what we've seen as market volatility and a pullback in valuations and a pullback in stocks. I don't think we have been surprised by this. I think we've probably been surprised a little bit by how much media attention and coverage the tariffs and policy has been getting. And we feel this is a healthy period that the market has gone through. So, with that, I'll kick it to Andrew to talk a little bit about a deeper analysis of returns and asset classes than what we've got here on the screen.
So this is one of my favorite charts of all time. For folks who I work with, we show this pretty often. These are all of the asset classes that we use in our portfolios, and it's actually tracked from 2010 all the way to 2024. And it also gives us a year to date as of the end of the quarter. And so, we're looking at US equities, large, mid, and small. We're looking at international equities, emerging markets and developed markets, fixed income, cash, commodities, and real estate. And what we see, it draws your eye to an asset allocated portfolio and how that performs over time. That if we're including all of these different asset classes in our portfolios, even though we're inundated with the news of domestic US markets and some of the trade expectations and wars we've seen, if we look year to date as of March 31, the US large cap and US small cap are the only two that were negative for the quarter. And so you'll see that cash was 1%, high yield bonds, REITs, fixed income, emerging markets, and commodities and developed markets that are international are all positive for the year. So we have, since this chart, seen some volatility at the beginning of Q2 or the beginning of April with the announcement of tariffs and some other things. But what we're seeing is that, as we create portfolios and manage portfolios and advise on clients who are managing their own portfolios, we have to build them to be resilient. And what a resilient portfolio looks like is a well-diversified, global, and different asset sizes and different asset types that are not correlated to each other. So that even though we know there will be volatility, Jason mentioned we expect there to be corrections on an ongoing basis. And it's really tough to say what will do best in the next 6 to 12 months. What we know is that an asset allocated portfolio over time gives you the stability for financial goals, whether that's an individual financial goal or an institutional financial goal, to be able to have some predictable return long-term to achieve those finances. Anything you'd like to add to that, Jason?
I just, the dynamic of questions that we get from clients, I think a couple of years ago, it was kind of like, well, my portfolio and the S&P 500 don't look the same, right? Like the S&P 500, which is the large cap US equity index, you can see 23 and 24 beat every other asset class. But as we invest money for our clients, like we do it in a diversified asset allocated fashion. So the returns won't look like the S&P 500. And when we look at, large cap this year, same thing, right? We're going to be a little bit more moderate than that. So, I think it's just an interesting dynamic to see how the questions change, how the framing changes, and how US media kind of dominates and only really talks about US markets when we've seen some strength in international equities and other areas of markets that have done well. It's a great chart. Thanks for sharing it.
Yeah, we got a question in the chat. Do you think we're headed for a bigger correction, or is this just short-term volatility?
I left my crystal ball at home, but I think we're always going to see short-term volatility, right, in markets, right? And I think as you look at, extending, and we'll talk about this a little bit later in the slide deck, but as you extend your duration, your time horizon, volatility and ups and downs become less relevant, right? I think it's kind of congruent to personal growth, right? Like if you're saying, well, I'm going to exercise every day, some days you might exercise, some days you might not. But if you have that focus for 10 years and you exercise 80% of the time, it's going to seem like you had consistent kind of returns and the feeling that you want, maybe looking the way you want, even though you missed days and had down days, right? So I think it's the same thing, time framing in the market. We're going to have issues. I don't think we're headed for a complete market restructuring where we see international equity dominance for the next decade. But I do think corrections like this are healthy and they bring valuations back down to reasonable levels, and you really right-size capital markets. US equities are really expensive. So, I think this was prudent.
Yeah.
I see we've got another chat. What's the ideal target mix for the global portfolio percentage-wise? So I think maybe to disaggregate that question, thanks for asking it, Ted. As we think about maybe a US and then international split in portfolios. So if you kind of have all of your money invested in a portfolio, how much is in US markets versus how much is in international markets? I think that's what I'm hearing. The broader world ETF or world index benchmark is about 70% US, 30% international. I think we want to think about having that as a target and how we adjust within the market. Maybe we overweight international a few percentage points, right, in valuation periods like this. Maybe we underweight US or because of currency dynamics in the dollar and how that impacts kind of international versus US equity returns as well.
Yeah. We got a question for Mary also. Can you speak to rebalancing one's portfolio understanding there's not always a good time, but as markets change, but is there a time to consider serious rebalancing? Thank you, Mary. I was actually thinking in this chart really shows the power of rebalancing. That, as we see large cap or S&P 500 with a 26%, 25% return in 23 and 24, we're consistently rebalancing. So there are some times where rebalancing makes sense based on time frame. So you'll see some folks who might rebalance quarterly or twice a year or once a year to get back to a specific asset allocation. So for instance, if someone has decided to do a global portfolio, 70% US, 30% international, after the returns of 23 and 24, you would have had more US stock allocation than the 70% target. So getting back to rebalancing on a systematic basis is really important. And one of the other ways that folks rebalance is with certain ranges. So if we talked about a 70% target and we get up to 75, that may trigger a rebalance. So I think rebalancing is a vital part of keeping your correct risk profile and your correct asset allocation as you go forward. And that's something that we find to be important and that we communicate with our clients on an ongoing basis. Great question. All right. Well, we were going to do a post check, wanting to hear from the group. So glad we have already started some talk back, but we really want to know, how are things feeling as far as your portfolio, how you're digesting the changes or the news? Are you feeling optimistic? Are you feeling good about how things are? Or are you maybe feeling not so good? So love to take a quick moment. Feel free to drop it in the chat, how things are feeling, how you're feeling about your portfolio or financial picture going forward. Thumbs up, thumbs down. Yeah, that's better.
Do you mind if I just talk?
Yeah, sure.
Yeah. So I think obviously concerned, right? But I'm also trying to understand whether, given age and time left to invest in all this stuff, does it make sense to potentially take more risks or see this as kind of an opportunity, right? Because at least in my personal situation, I've had to kind of rebalance more capital towards hard savings, right, to stay a little bit more liquid. I've taken some steps already to start investing, but I mean, in a sense, would it make sense to start investing heavier in the market now, given where things are going, or because we're already saying like, hey, look, international markets likely are not going to dominate for the next decade. We're talking about a correction here. Would it make sense to buy the dip?
I think that's a great question, Ted. So you mentioned having time in the market or having, time left before you need those dollars. And I would say, liquidity matters, right? What we don't want to have to do is liquidate stocks at the bottom for cash needs or emergency needs. But on the personal side, if you have the cash savings liquidity that you need and you have a longer term time horizon when you would, be needing these funds, seeing some of the largest, most profitable companies come down 10, 15, 20% on the price to buy in is an opportunity to buy. Now like I said, each situation does vary, but in the long term, if we're looking at, being able to buy discounted equities or just the overall S&P being discounted, if we have a long-term time horizon, this can be seen as an opportunity if you have the stomach to really ride this out.
Okay, thank you.
Which I would define at 10 plus years. I think we got a question in longer term time horizon.
Yeah.
I've got 2 children. We've been blessed with some great kids. One of them's 3 and the other one's 1. We've got 529s for the kids. So the 3-year-old we've been contributing to for the last couple of years. And, we're overweight international and emerging markets, right? So even to the point about domination of markets, where are the growth potentials kind of in the global economy? Most of them are in emerging markets, right? And as their markets get more robust and developed, right, if you've got 10, 20, 30 plus year time horizon, I think making sure you're exposed to those markets is really important. I do think that to your question, Ted, and to the question earlier, just rebalancing your portfolio may actually deliver the kind of buy low, sell high, dynamic into your portfolio. So I would maybe think about, well, what is my target allocation, right? If I set a target, if I rebalance my portfolio, what would the dynamic be? And make sure that target is appropriate with that time horizon and your comfortability with risk. We can certainly help do that as well. But I think making sure you have a target portfolio in a period like this, and you're not just thinking like, oh, well, things seem cheaper, so I'm going to buy. I don't know if we want to be quite that opportunistic or tactical.
Got it. Makes sense.
Yeah. So we see some thumbs down. We got a couple, 1 or 2 thumbs up, feeling good through this time in portfolio with time left. Okay.
Also, to just throw an appreciation out for our audience. Thanks for joining and engaging in this. And honestly, I love the spectrum of colors of thumbs that we have here in the chat. I think it's a good representation of our diverse firm and like the folks that we're serving. It's cool to see. Well, great. Well, let's trudge along. I think we may be able to give some good insight and outlook as to kind of how we're thinking about negative and positive optimism here. So Andrew, you want to kind of hit us off with these outlooks?
Absolutely. So these were the 5 things we are looking at going forward as we decide some of our tactical decision making. I'll also say, I really want to reiterate, we set an asset allocation for specifically short, medium, or long-term goals, and we're not deviating from our asset allocation based on these things. These are tactical changes that we might make or things that we're looking out for if we want to make smaller tweaks to the portfolio and how we're allocated. But key index forecasts, right? Expecting volatility in the short term. We are expecting there to be volatility as, for a multiple of reasons, right? We have the geopolitical piece that we'll talk through a little bit, tariff, trade. And so we are expecting to see short-term volatility going forward. Interest rates expectations. We have a lot of folks who have a significant amount of bonds in their portfolio, and bonds can be a very good hedge to volatility going forward. But we're keeping an eye on interest rates, because tariffs have a say in inflation, and inflation is one of the key indicators for interest rate decision making for the Fed. So we're watching how these changes change interest rate expectations and change bond allocations as well. Global diversification, we've hit on this a lot, so I won't spend too much time, but making sure that you are holding a diversity of global equities. We do believe that tariffs are noise, that as you see announcements that get rolled back and new announcements that get rolled back, there is a negotiation of some sorts happening that we don't believe will change the long-term capital market assumptions that we have and the long-term returns for certain asset classes that we've built. If that changes, we'll update those. But as of now, we see those as noise. And then, the market cycles. We have, as you saw from the grid chart, we have had a really good run of growth in equities, specifically U.S. equities. And so we do expect that we've seen, what can be described as a correction, flash correction, but that these are part of normal healthy market cycles for there to be investment, increase in growth on equities, and then a pullback to what would be, different pricing that would be more affordable and a drop in certain equities. So we do believe that this is behavior, although very sensationalized, this is behavior that is actually sitting in the normal market cycle that we've seen in the past. All right, I'll hand it over to Jason to talk through here.
Do we have a question?
Yeah, I was gonna, maybe I should hold this to the end, but what would be example of something that would be irregular or something that is not within the norm?
Great question. In terms of like a market pullback or
Yep.
yeah. So I think this chart may speak to a little bit of this. What we're looking at here is a red dot that indicates in certain calendar years how much the market was down during the year. And then the gray bar representing what the market ended up returning that year. So this is the S&P 500 or US equities. And you can see we've had a number of years where 2020, great example, right? Market down 34%, ended up 16, right? Volatility is normal, right? I think things that we would see that would be not normal, I think would be a large correction in some of the biggest drivers of US GDP, which is changes in consumer spending. Consumer spending represents about 65% of economic output. So if people stop spending money, that is a material change to company earnings and a lot of dynamics happening in the economy. The second is a material change in corporate investment. So how are companies investing in their business and in the places where they operate to drive more sales and earnings? Those are the two biggest drivers of economic output. If we see material changes in those things, that would represent a deviation from kind of the norm. And that's what triggers a recession, as an example. So you see those things pull back, we see negative GDP, you know, on this chart during periods where we've seen that, right? Obviously 2008, you can see kind of, you know, market down 49%, ended down 38%. That recession kind of bled into 2009. The stock market tends to outrun or be ahead of recession. So kind of pulling back on the front end. But then as the recession really sets in, people start forward looking and the market kind of feels optimistic about the future. So, you know, I think we've got to come to a place where we expect this volatility in the market. These are things that happen, the news cycle, investor sentiment, blips in corporate earnings, all can be drivers of, you know, volatility. And I think making sure we're rebalanced, making sure that we have a systematic process to ensure portfolios are invested to the risk level that they should be are ways to mitigate that. And this is a chart that I referenced a little bit earlier, just about how volatility compresses over time. So the longer your time horizon, what is the range of stock returns that happen during that period? So as you can see all the way on the left, we've got stocks, we've got bonds, and we've got a diversified portfolio. And that is 60% equities, 40% bonds. So stocks in green, bonds in blue, diversified in gray. And you can see at the 1 year all the way on the right, the variance of returns that occur in a year's period is super wide. Anything can happen over a year, right? But as you extend this period out over a longer stretch of time, 20 years plus, we tend to see positive compounding returns, right? And you can forget about that year where there was volatility, right? I mean, look at probably your portfolio. If you've been invested for 10 years, you see your value today versus what it was, you know, 10 years ago. It's materially different, even though we've seen some pretty significant episodes of market volatility along the way. So I think this is really what, you know, there was a question about how do we define time horizon. But I think as we start to get in the 10, 20 year plus, that is a long-term time horizon where, you know, volatility is going to occur. I would try not to check your account every week. It's not always going to be the most relevant, right? And checking on a longer arc and time period is really, I think, how you should set expectations for what your portfolio may be able to accomplish. On that note, you know, this chart doesn't really take into account other asset classes outside of public stock and bond markets, right? We think about alternative investments, we think of commodities. We've introduced gold as an asset class in some of our client portfolios. There are ways to generate returns outside of kind of your traditional markets. And I think those should also be considered. When we go back to that quilt chart, commodities are up the highest year to date based on kind of a percentage return basis. So having that stuff incorporated in your portfolio can help mitigate some of this volatility, even over a 1 or 3, 5 or 10 year period.
Great point. So we do want to jump into some of the key takeaways for today. We are leaving space for Q&A. We love that there's been conversation during, but we are leaving some space for Q&A. Key takeaway one, the market correction that has happened in 2025 was due to a fragile market for some reasons that we talked about. So the inflated pricing, geopolitical side of things. And so, it just lit the match, right? It was the impetus for the fall, but we also saw some of this coming, and creating portfolios that are diversified to really manage that were really important. Tariff and geopolitical tensions should be viewed as short-term, not long-term. So if you have a long-term time horizon and we've created a portfolio for long-term growth and returns, we would highly recommend to stay the course. And then diversified investment approach. We talked about stocks and bonds. We talked about domestic and global allocations. I love that Jason just mentioned also alternative investments and commodities, things that are not correlated typically over time with stocks and bonds that can help weather and make your portfolio more resilient. So these things are extremely important to have in your portfolio. And we also see, as we talk to clients or we talk to prospects or folks who are asking us for advice, that a lot of times we don't have some of those assets in the portfolio baked in. So with that being said, we'll stop for Q&A, but I will say this QR code here, you can scan and you can upload a statement and give us your information, and we'll do a portfolio audit. In this moment in time, we think it's extremely important to have a second set of eyes and jump in and let us talk through if the asset allocation is correct, if the time horizon is correct, if the risk tolerance is correct for you in your current situation. So we'd love for you to scan this QR code and upload information, and we'll get back to you as soon as we can. With that, we'll open it up for Q&A.
I hate to dominate the room like this, but one of the other questions that I wanted to ask was understand the larger trends that would signal, market issues and all that stuff. And we're saying that a lot of this is kind of sensationalized because of media and what kind of the government's doing now. Are we seeing any major behaviors that could lead to basically a recession? Like, can we look at any of the things that the government's doing now and say, hey, look, this is going to tank us? Because obviously there's a lot of social media out there that has that as one of the chief concerns. Want to try to get a sense from a financial perspective if we actually believe that there's a likelihood that actually could be true.
Well, we listen to a lot of economists and do a lot of studies from some of the top economists in the nation and globally. And there have been an uptick in the percentage of expectation of a recession this year. I believe that JP Morgan Chase moved from 40% to 60% in the middle of the most heightened tariff introduction. Whether that's still the case now as rollbacks have happened, and there's some indications that the China rollback might happen, remains to be seen. But I do think that what Jason mentioned about our domestic GDP really being tied to consumer spending and business investment, if those things continue to grow and be expected, and folks keep spending and business investments keep happening, it would be a tough scenario to see. But we've seen some variants of actions from the administration and from other folks as well. So we are monitoring it. We can't say definitely that there won't be any actions that cause a recession this year or next. But what we can say is that, if the right time horizon is picked and the right asset allocation is created, that we can weather through recessions, we can weather through drawbacks in a portfolio the right way with the right global diversification and rebalancing.
Yeah. So bottom line is, even if we enter it, we shouldn't change the strategy that we already have in place. Essentially, we might modify or tweak it here and there, but just stick with what we got.
I agree. The only big modification I would say is liquidity.
Yeah.
If we can look out for the next 2 years and make sure that we have the cash available for weathering a downturn of this amount, or moving into bonds a little bit more to weather a downturn, I wouldn't go risk off if we have a longer time horizon and we pick the right asset allocation.
Okay.
Great questions, Ted. We appreciate it. We appreciate it. No comments.
They're good. I think thank you, Ted. And I think just maybe getting outside of like money management, portfolio management is a little different than the economy and how we feel the economy is going to trend. They're obviously related, but the stock market is often not attached to the real economy. So, I think we're looking at really understanding what this administration, and it's difficult to understand what their end game is, like for lack of like, we don't know like what the end, I assume we're going to try to see like a tax bill and like taxes reformed for like wealthy individuals and corporations and the playbook. But, tariffs on goods, maybe there will be tariffs on services in the future. Like the current tariffs have been proposed are on goods. I think if we had a tariff on services, I think that'd be like a whole new world and dimension that we'd have to sift through. I also think we've got a lot of policy uncertainty, right? It's difficult to know if the budget that comes from this administration, the proposed budget, is going to be inflationary, right? Is the government going to spend more and increase the deficit that we have between spend and economic output, right? Or are they going to be not disinflationary and reduce the deficit by spending less? Our monetary policy, the Federal Reserve, is waiting to see what that budget looks like because they don't want to lower rates. And then we have an inflationary budget and now prices for everything get unsustainable for almost everyone. So I think the policy and the budget announcement, what this administration plans to spend money on, will be a big thing that's going to come out that we should be paying attention to. And it will have an impact on the economy and likely different markets and asset classes.
Okay, helpful.
We've got space for questions. If you have questions, feel free to get them off mute and ask or drop them in the chat. Okay.
Hey there, folks. Can you hear me?
Yes, we can. Hello, Vanessa.
Hey there. So thank you for this. It's really great. A lot of people, well, I'm involved with a couple of foundations who have started to move into private investing, say through funds, et cetera. I've started to do a little bit myself. And I'm hearing, 10%, no more than that. Can you talk a little about sort of the role of private investing, particularly now, with what's going on? And my profile, just to speak to me, right? I'm retired. I'm about 4 years into retirement, and feeling pretty good about the portfolio, but excited about the opportunities in the private market space, particularly for investing in things that are hopefully sort of solving the problem of, well, most of our investments that are making the most money are sort of toxic, right? We're killing the environment with AI and things like that. So anyway, there's a long way to ask a question about what do you think about private investing?
I think that's a great question. Yeah, I'll hand it to Jason. Yeah.
Thanks, Andrew. A great question. I think private markets should play a role in every investor's portfolio. We talked about this on the last webinar. Most of the economy is in private markets, right? 85% of companies that generate more than $100 million in revenue are private. 98% of all companies in the country are private. So if you don't have private market exposure, you're likely not fully diversified in your portfolio. So it's an important consideration. I think for thinking about retirement and private markets often introduce a level of illiquidity, so you can't access your money tomorrow after you invest it, right? And tend to have a certain duration, that is tied to them. I think Vanessa, in your case, and just quick case study, and thank you for asking the question. I think you want to focus on that duration and having set duration dates in those private investments. I think if you go out and make a lot of private equity or venture capital investments that don't have a defined time horizon, they could, extend out 10, 15, 20 years. in your case in retirement, that may not give you the liquidity necessary to kind of make sure that you have cash flow for retirement. So I think as you think about your allocation, right, how can you invest in things like private credit or a bridge loan to a company that is, doing something great, but maybe has a financing gap, and you can do something that has a 2-year duration. I would try to focus on shortest duration possible in private markets at this moment. There's uncertainty, particularly with people that have like federal contracts or even corporate contracts where they're earning their revenue. They're not going B2C. That B2B or B2B2C model may be strained in an environment where we have like a recession or, uncertainty, higher inflation, higher interest rates. So focusing on being shorter duration in some of these private investments is really, I think, a really critical step. And, I could give some examples about how to structure those securities, but I hope that is a good answer to the question.
Thank you. That's helpful.
I would say on the percentage section, you said 10, we've seen studies around 10 to 20% in private markets, whether it be private credit or equity or anything there, giving you great diversification and an increased return over time. I do think Jason nailed it with the liquidity or illiquidity of those investments, so to be smart there. But we're usually not seeing, even with a long-term allocation with maybe even a foundation that might want to go into perpetuity, above that 15 or 20% allocation there.
Okay, that's very helpful. Thank you.
Okay, I know we're a little over. We're free for more questions. We really appreciate the engagement. I think these are wonderful times to get clarity. Please reach out to us individually as well if you have questions that you'd like to take offline, or if in the middle of dinner tonight you have an aha question that you want answered. And then Jason, anything as we close out or that you want to leave the folks with?
No, just express some gratitude for you, Andrew. I thought this was great. Appreciate you sharing this information. I know Sarah's on here too. Sarah, thanks for helping us with the presentation. A lot of gratitude for our team kind of sifting through these murky waters and making sure we're step up to deliver for our clients. So I know some of our teammates are on the line as well. Let's keep at it. And for everybody who's a client or involved in our community, thank you for joining. These are the times where I think we've got to over communicate, ask questions, and make sure we're thinking straight. So I appreciate your engagement here today.